Hi everyone, hope you're doing well. Today I'm going to talk about a brand new stock I'm buying. This stock is a turnaround play. So you guys know me, I like buying stocks when they are hated. Nobody likes them. And quite often those stocks, that timing can be the best time to buy stocks. And as long as you can see that the company is moving in the right direction, the fundamentals are getting better, some of these stocks can be serious winners. And the difference between, I would say, a turnaround play to beating up stocks. So I always like buying beating up stocks because quite often beating up stocks, there could be actually like nothing wrong with the business and the market sends it down, or there might only be like one short-term issue with that business, and you're like, well, the market's overreacting big time to it, and then they'll go on to do very well. Like SoFi, for example, market didn't want it at $6, it's now $20. DraftKings, the market didn't want it at $10, it's now whatever after its earnings jump, $45 or whatever. Hims and Hers, nobody wanted it at $3 because they said that it won't make profitability. People paying $50 for it now. We see it all the time. AMD this year. AMD was $70 3-4 months ago, and now people are queuing in at $170 to pay for it. And there was nothing wrong with the business. Like financially, they were executing absolutely amazing. And now the market goes, oh, actually, you know what, we like it. Where the turnaround plays, I'd say like there has been a lot more go wrong with it. This has been really smart. Like this is the typical story of the. You've got a previous management team. The management team have been inadequate at the job, done a poor job. They've loaded up on the debt. They've tried to make acquisitions. The acquisitions have been pretty poor. Loaded the debt up on the balance sheet, and then basically you've had a few other situations that have gone against you. And that's the case with it. And we're going to take a look at it. So I am buying this stock now. I've not really bought too many US stocks, but I've recently bought PayPal in the last couple of weeks, and I bought this one, which is a US stock. And I bought the stock. I thought the recent earnings were good, and I bought a start position. And as long as I see in future financial results the earnings are getting better and better, I'll continue to add in my position. But I am still being a little bit more cautious with this one because it is quite early on in its turnaround stages. But I have started buying it. Before we do get onto the stock, if you do want to see more exclusive content, guys, links in the description. I dropped an earnings review on Hims and Hers the other night. And if you do want to start investing, join eToro. Link in the description. You can go buy some shares on eToro. I'm on there as a popular investor. So, no, without wasting any more time, what is the new turnaround stock? Well, it's a company called VF Corp. It's a $12 stock. 4 billion market cap. It does pay a dividend of around about 3%. And you'll be able to see from the share price here, yes, it has been absolutely whacked. Zoom out a bit more. Look at that. Yeah, this stock was at its peak around about $100 stock. And now it's a $12 stock. So yeah, a pretty significant fall down, nearly 87% since its highs, which were only about 5 years ago. Historically, it has been a good performer in the stock market. And then, yeah, it's been absolutely crushed, as you can see here. Had a little bit of a rally back up in the start of the year, to be fair, up 100%. And I actually thought, oh, I've missed the boat with this one. I was actually interested in it about a year ago, and I was keeping my eye on it, and it rallied up for, oh, I've missed it too late. And then recently the market's kind of, giving it all back again. And even this week, it's been a volatile one. If I just zoom out a little bit, you can see here there was a drop to $11. We then had a big bounce up to about 15%. We then dropped another 13%. We're having a bit of a bounce up. So yeah, it's been all over the place at the moment. So yeah, it's been quite volatile. So VF Corp, let's have a look here. So if you don't know what VF Corp are, they are a clothing retailer. We've got Vans here. We've got North Face, Timberland, Dickies, Ultra. I don't know if that's how you say it. You'll probably see a couple of other brands here that are pretty big brands overall. But yeah, some pretty decent brands in this business right here. And yeah, overall, the stock has had a tough time because, as I said at the start of the video, all those things have kind of gone against it. It had, from where we were, only 2 or 3 years ago when this was back up at $82. They had management team that's mismanaged it. They made acquisitions. The acquisitions haven't worked out. The acquisitions made loaded on a load of debt. They then had all this kind of big inflationary environment that they've struggled to manage through. They've had a couple of the brands come a little bit unpopular. They had the big surge in the COVID times, people doing the online spending, and really not really bounced back since then. And can they get back to where they're at is really the key thing. So The first thing that really caught my eye with this one is management change. So they did make a management change back in July 2023, and it's been obviously bang on really 2 years since we had the new CEO come in, Bracken Darrell, and I thought this was a great appointment. This is one of the main management teams quite often make or break your investment. They are the people there day to day managing your investment, and as much as sometimes you think a business can have a good idea, and you can come back in 5 years' time and go, bloody hell, that didn't work out. And you think, how did it work out? And you realise, actually, look back, and some of the decisions the management team were making were absolutely disastrous. And I'm looking at Bracken here, that's coming at what we've got at the moment at VF Corp. And I'll be honest with you, like, he is a good 75% of the reason why I'm buying this right now. So he is a guy that actually has very good track records on doing turnarounds previously. He is referred to as being the main reason why Logitech did so well. So Logitech, it was dying, it was going to go bankrupt, and he came into Logitech and created so many amazing products. Sales did really well, and basically I think came in about 2012ish, and I think he left in about 2022 or something like that. And the stock was a significant performer. We saw in basically a 10-year period, Logitech basically went on to be a 10-bagger. I mean, at the peak in 2021, Logitech was 1,000% return in his 10 years at Logitech. Turned it around from a company going bankrupt to the stock performing incredibly well. And the other thing as well is that he's not only done it once with Logitech, he then also went in and he revived the fragrance brand Old Spice as well. And he turned that around. So he's done it once with that brand. He's done it with, obviously, the big one as the CEO as Logitech. And with these turnarounds, normally you only get better as you do them. As Bracken likes to say, is that, this is my third turnaround play now. And the thing is that you would hope now I know how to do things faster, better. And he's making some good moves. He's been hiring a lot of good staff. He stole the old I can't remember the exact title at Lululemon, and that's one of the reasons why Lululemon had so much success. And what I'm starting to see is the turnaround, I think, starting to appear in the financials. In the latest earnings, we saw an EPS beat, we saw a revenue beat, and excluding now only Vans, the revenue was up 6% year over year. They also had pretty decent guidance as well. Worth pointing out that they did have some timing benefit with the wholesale, and also they have a bit of an FX benefit at the moment. But this is massively better than where they were previously, because if I was to go, they're basically flat on revenue. If I was to scroll back to something like, I don't know, let's just go back here to 2024-ish. Let's go August 2024, about a year ago-ish. So you can see here revenue was about down 8%. So he's got it from already declining 8% to about flat, which is great. If I go back to 2023 and see what they were declining in 2023, let's scroll down. Can we find August? Let's just go with October. I'm not scaling anymore. Actually, it wasn't too bad then, to be fair. But he's getting it back up in the right direction. So overall, when we look at the latest quarter, North Face still doing well. That's growing 6%. Vans is down 14%. Timberland is up 11%, and other brands are up 4%. America is the kind of weakest area at the moment, but Europe and Asia, the Asia region is not too bad. So really overall, they just need to improve the US side of the business at the moment. And Vans is the last kind of business that they really need to turn around. There's a few changes going on around with Vans at the moment. We'll get to them. Some of them are like closing stores down. So when you are closing stores down, you're naturally going to see a drop off in the revenue. And they say that if it wasn't for the closing of downs of stores, there would have been about 8% there. But as long as they can drive the growth back in Vans, the other parts of the business actually are doing pretty well here. If I just go back to some of the screenshots here. So the opening statement in the last quarter from Bracken was, we performed ahead of expectations and guidance in Q1 2026, improving our top line trends versus last year to flat, while delivering a much stronger bottom line. The North Face and Timberland sustained their positive momentum, while Ultra, which is the other brand they have at the moment, grew strongly. Vans was impacted by channel rationalization actions as we strengthen the business to return to healthy, sustainable growth. So if you look at the operating loss, that was 87 million, which is better than the guidance of 125 million. Don't forget, this is Q1 as well for these guys. This is typically one of their weakest quarters as well. Obviously the big one is when you get to like the Christmas period. Big thing that the looks like, you can see a sign of a turnaround is if you look at operating margins of 4.9%, up 210 basis points. So this is, and also gross, if you just see there, gross margins up 270 basis points. So this says to me is that the actual margins of the business are improving. So they're actually able now, they're getting a bit more control on what they're actually selling at the moment, which is a great sign that they're starting to see that happen. Net interest expense of 41 million, as you can see here. That's a big thing that's affecting them at the moment. They've got the balance sheet was a mess, so they've got to sort that out and have started sorting that out. You can see a net down was improved as well. So that's a great thing that they strengthened the balance sheet. Now, if you look at the revenue declines and moderating, you can see here basically at the moment we're starting to see the trend of financial year 24. Really the big steps kind of creeping in here last year, and you can see here we're starting to move up significantly back up in the right direction, and on the trend there we are on the path. We already have seen one quarter back up in the right direction. Looks like we could see the other quarter starting to get back up into the right direction. So the trend here is that the sales are improving at the moment, which is great. Now, the net debt, like I said, is the big issue. They sold off one of the brands, which I think is Supreme, to try and strengthen this debt up. So you can see here they are going from a 6.7 billion. They have reduced that now down to a 5.3 billion at the moment as well, and they continue to get that back as well on a leverage target of 2.5 times. So yeah, that's a great thing that they're prioritizing sorting that debt out at the moment as well. If you look at the conference call as well, so we dramatically improved our cost structure, reduced well over 300 million of costs, and they said that they have another 500 million to 600 million of net operating improvements in our sites. So you can see here, like, okay, the big thing is they're trying to do some cost cutting, and the fact that they have identified already where they can save another 500, 600 million. Obviously, if that flows through on the balance sheet, that will obviously be dramatic on the profitability side. When you are talking, what's VF Corp right now? So yeah, 4.7 billion market cap, significant amounts of money we're talking about there at the moment. The balance sheet wise, they talk about how much they're trying to strengthen it and get it to the target of 2.5 times leverage by 2028. As well as that, they also talk about the Ultra brand. They're saying that is growing 20%, so that could be a sneaky new growth driver for them potentially. I have seen them actually popping up in quite a few stores at the moment. Only 10% awareness as well in the US, so big potential for that to scale up at the moment. So they're seeing, so when you look here as well at the moment, they said that over the last 2 years we closed around 140 stores, about 20% of our global network. While it's tough medicine affecting revenue, it's improving our profitability. So this is the balancing act that they've got at the moment. They're kind of shifting all these stores down, closing all the unprofitable stores, and get all the profitable ones working. So what we're going to see is we see revenue declining at the moment, but eventually when it'll get to a point where they kind of stabilize on the revenue point of view, and the profit will then come up because they don't have these unprofitable stores, and eventually then we'll see the revenue start following the trend at the moment. They said that they also now have about 90% of our full price America stores provided greater gender clarity. So the saying of going less work and all that sort of thing at the moment. So they also said that they are in Europe at the moment having higher average selling prices, 35% higher through a more premium product offering. So this is the other thing at the moment, is that they're trying to, what has previously happened with the company, in my opinion, is that they've kind of got like a basement company where it's like, it's one of those things in the apparel space. You don't want to be a low-cost brand, because if you become a low-cost brand, you're not seen as being a popular brand. So what all these companies have is they go through a cycle of where they're like, high prices, everybody loves them, like, oh, because it's expensive. And then eventually they start bringing the prices down to keep up the growth. And then eventually people go, oh, that's not a popular brand now because it's a cheap brand, and then they have to go through the cycle of going more of a demand price. And now they're bringing all these new products out that they're kind of, where you have like Vans, for example. Vans used to be 40, £50 shoes, and now they're cycling up. If you go on Vans website, like they're charging like 120, 130 quid for these Vans shoes, and then eventually, they will kind of come back up into the trend at the moment as they cycle out all this new stock and then come back into fashion. Another thing, Vans, to get back to popularity, they have brought back the Vans Warped Tour. That's always a great attraction and advertising for them at the moment. And what we're expecting to see here is, if you look at the forecast, is we're starting to see the back end return to growth in this year, and then next year another return to some decent amount of growth there. If they can drag up the net profitability back to what we're expecting, which is around about 296 million, 16 times earnings, and then the year after 406 million, 11 times earnings. Now if you look here, 406 million is still way below where they were in 2020, and that's where they had most of the shops stuck. Shut. And in 2022 they were about a 1.3 billion profitable company, so this is still like a third of what they were doing back in the 2020 times, and that's going to be the key thing, is to drag up the profitability. Now if I do look at the numbers here, so I've only put 1-3% revenue growth in, so not assuming crazy growth. The big thing is to get to a 3 to 4 to 5% profit margins. Now this company, before all these issues, they were a 10% profit margin business. So my profit margins are assuming that they get back to about half of what they were doing previously. 20 times earnings, which I think when you look at VF Corp, they normally do trade around a 20 something times earnings. I think the average is 30 times earnings, but there's a lot of fluctuations in the PE. So let's say they do go to like a 20 times earnings business. Low side, 20% return. So even like worst case scenario, they get only 3% profit margins, 1% revenue growth, 20% return, and obviously you get the dividend as well. So 15% on top. You walk away, 40-50% return. Mid side, you 76% return. You add your dividend on top there. 90-ish% on that side. And then on the high side, you're getting 128% a dividend on top. You're getting towards your 140-150% return. Now, like I said, this is assuming that they don't get to a period of time where they get back to substantial amounts of growth of like 5-6% a year. And that's me not thinking they can get anywhere close to where they used to have the profit margins, which was about 10%-ish. If we do see the point of view where VF Corp do achieve a 10% profit margin like they historically used to do, if they do manage to grow, that's the revenue growth. Let's say they do grow like 5% a year, which I think is achievable potentially, and especially with the low base that they have at the moment as well, with how much they've been cutting the stores and everything like that. If they do achieve the profit margins of what they historically used to do, which is about 10% profit margin, very quickly we'll get to a 400% upside on that. So this is why I'm buying VF Corp, is that I think that I could make 100% on this if they just kind of get to half of where they used to be. And I think under the management team, I think they can probably get, I think Bracken's going to get them to at least half of where they used to be, and to some form of small growth of 2-3% a year. I think he can get him there, and I think he can get him to 4-5% profit margins, which for me I make it 100% return on. But the other reason why I'm buying this, if it was just that, I wouldn't take the risk on this, because I say the risk of it actually turning around in the debt here, not worth me buying. My hope is that we do see VF Corp get back to its bit more of its prime days, where it does have 5% revenue growth, and we do see those profit margins get back to where they were 10% profit margins. Because like I said, if they do get to that point of view, that's where you start talking a 4x opportunity, and that's why I'm buying this. Is that okay, I can make 100% upside. I think that's where they come in with quite cautious numbers. If he is really able to turn the business down, I think you could get a 3-4x. But obviously that's like perfect situation, which obviously doesn't always happen. But that's what's getting me over, is when I look at the reward side, like it could do quite well if they do really execute on the turnaround. So we'll see. Like, I think at the valuation I'm at, I'd still do okay if they don't completely turn around. But if they do get back to a really popular brand here, and back to the old days of growth and profit margins, like it could do well. So I'm buying it. I'm being cautious because it is very early on the turnaround. And the more I see earning reports where it's showing the signs of moving up in the right direction, I'll be willing to add more in here. So that's the update on the new turnaround play, guys. Hope you enjoyed it. Thanks for watching. See you in a bit.